equity market has been in a trading range since June, trying to figure out, is the Fed going to cause an accident and cause a recession from which it will be hard to extricate ourselves? We believe, if we had to take a position on that right now, we believe this recession is much more of a supply chain related inventory recession, and that it will clear up pretty quickly. Although, economic statistics are so lagged that come this time next year, we might still be arguing if we're still in recession. But we do think in that period, both inflation and interest rates are going to come down pretty dramatically. Inflation below 2% and interest rates, I think, will be surprised. Jeremy Siegel thought that we would see 2% interest rates. I found that very interesting. We do see one market suggesting that this point of view is correct, and that's the bond market itself. Bond yields peaked on October 22nd, I think, at 4.3% and are now down near 3.5%. That's a pretty dramatic drop in the bond market. And the yield curve is now, if you look at the 2s to 10s, I think it's inverted by 77 basis points. Again, a very steep inversion given the level of interest rates we're at. Commodity prices, one of the most influential from a sentiment point of view is oil. It peaked at $130 on March 7th and is now down to $80, despite the fact that we're getting all kinds of reasons for the oil price to turn back around. One is OPEC is concerned at the excess supply out there and is threatening to cut production even more than it already has. Two, China is starting to stimulate, although it's stop and go. From a monetary point of view, they are stimulating. COVID-0 is a problem. There's some signs that they want to loosen that up. And if they do, then that will increase the demand for oil. And then, of course, our strategic petroleum reserve, we have to start putting oil back into it. It's back down to 84 levels, 1984 levels. So that will be another incremental source of demand. Nonetheless, the oil price keeps going down. What's fascinating to me is in the face of that, the XLE, which is the S&P Energy Sector Index, is near an all-time high. Now think about it. The oil price has gone from 130 to 80, and typically that index trades with the oil price. It has not this time. It clearly expects all the variables I mentioned to boost oil prices once again. But if we're right, that may not happen because the move to electric vehicles, I think faster than most people expected. And we're now beginning to see some Ubers and Lyft. We're seeing more Teslas in those fleets. And so the vehicle miles traveled in electric cars, given that these Uber and Lyft drivers drive a lot more than we do in our individual cars, we think that's going to cut back on the demand for oil more than many people appreciate. And as are all commodities, prices are determined at the margin, the marginal, incremental demand. And in our view, the incremental demand is going to fall short relative to expectations. And our call from a while ago has been that oil demand probably did peak in 2019. We may get back there, but if we do, it will be for a very short period of time. Copper prices have, as I've mentioned before, have come down from $5 in March to $3.85. During the past month, a number of commodity prices have had a bit of a rebound. I think that's partly because the dollar has come down and commodity prices are based in dollars. The unemployment rate stayed at a low at 3.7%, only 0.2 off its low from July and September. Non-farm payrolls were higher. The increase was higher than expected, 263,000 versus the 200,000 expected. But on the other hand, this is a typical economist way of looking at the world. If you look at household employment, that was very disappointing. It declined 138,000. And the divergence between non-farm payroll and household employment is stark. Since March, non-farm payroll jobs created have been 2.7 million. Household jobs created, practically zero, roughly 12,000. So that's since March. And think about that. That is when money growth started declining on a sequential basis. I don't think that's any coincidence. So the other indicators of employment that are pointing down include the Challenger layoff survey. It spiked by more than 400% in the month of November. Now, typically we don't see that except when we're in a recession, that kind of spike. So that another indicator. And the last one in the employment report itself was the average work week went down 1/10 of a point. Now, this is a pretty stable number. So when it declines, I take note. And it's basically businesses saying, okay, it was so hard to find this employment. I mean, these employees, that I'm not going to lay anyone off right now, but my business is down, so I'll maybe cut the work week and cut overtime. So that's also interesting. And, the more this divergence between non-farm payroll and household extends, the more I think the economic indicators are going to start becoming quite weak. I think household always catches the turn in a cycle. And as you know, we think the cycle did turn as household employment was turning in March, and that we fell into a recession then. And probably revisions will cement the case for that. But right now, GDP for the third quarter did come out up. Now, a big part of the reason was imports collapsing as companies tried to clear their shelves of inventory. So that's not exactly a ringing endorsement of how strong the U.S. economy is. Average hourly earnings did increase 0.6%. The expectation was 0.3%. That took the year-over-year wage inflation rate up from 4.9% to 5.1%. And the Fed's definitely watching this. Now, a counter to that is this work week decline means that total income, so average hourly earnings is just an average, but total income, when you measure all the hours,